Hey, this is John Starks. We down here on the street, and you watching Taking Stock.
2 minutes to go here into the closing bell on this Monday, which will kick off the first official full trading week for the month of May. Oil up, stocks down. West Texas and Brent both well over $100 a barrel. For his take on today's tape and what he saw into the closing auction, let's talk with the great Einstein of Wall Street, the institution. Inside this institution, Peter Tuchman. A weird start here for the first full trading week of the month.
I don't want people to think that this sell in May and go away is a thing anymore. It hasn't really been for a long time. I think people are just trying to get their footing. They're looking, what's the next thing to sort of bite into, and they don't have anything yet. We've disengaged the war. It feels like it's one more of the trade that oil up, market down kind of a feeling. There should be some fresh money coming into the market for the close, and we did see that. We were to buy over $1.5 billion all afternoon, but the market was not responding. So for everybody who's buying it, somebody's out there selling it. So it's rotational, it's not clear. People need a direction, and today's not the day to get it.
Is it maybe wait and see on earnings, wait and see of an easing of geopolitical tensions out of the Middle East? Because we had that behind us, and we came in today and we're reminded that maybe not all is necessarily well.
I agree, I think 100%. I don't think that we disengaged the conflict for a number of weeks while we were getting a lot of stock under our belt. Today's maybe a one-off. I'm not really clear. It's looking for direction. We'll see what happens.
All right, Peter Tuchman, the Einstein of Wall Street and Trade Moss, thanks for being here to kick us off. The team from JP Morgan Asset Management set now to do the bell. More Taking Stock after this. Easiest thing to do on that. All right, there you have it, and your final tail of the tape on this Monday, May 4th, to kick off the first full trading week for the month of May. The S&P 500 is down in negative territory, about 0.4%. The Dow 30 down 1.1. The New York Stock Exchange Composite Index also in the red, 0.6, and the small caps down 0.6 as well. As for the Dow 30, Salesforce, Merck, and Amazon, those are your strongest performing Dow 30 components. Your Dow laggards on this Monday afternoon: Home Depot, Procter & Gamble, as well as retail giant Nike. Energy and tech really the only sectors in the S&P 500 up, but plenty of laggards, materials, industrials, and consumer staples at the bottom of that scorecard. The Magnificent Seven tech stocks in mixed territory for today's trade as well. Amazon shares up 1%, Apple stock down 1%. Let's bring in Juan Moreno, managing partner at Nassau Street Partners. It's great to see you here. Thanks for kicking off the show with us.
It's good to be here.
So markets, I mean, obviously we're having this conversation on a day of a little bit of a pullback, but for the most part, markets at all-time high. They're taking the oil conflict in stride. What do you see when you look up at the markets?
Look, I think with the oil situation, at the beginning of the conflict, there was a lot of panic. I think the market is really starting to price in now the fact that there is extra supply coming in from Venezuela. There is extra supply from the U.S. that's stepping in. There's countries like Saudi Arabia that are moving oil through pipelines inland. So there's a lot of extra supply that I think a lot of analysts weren't counting on. And we're not seeing some of those doomsday scenarios that maybe we were seeing at the beginning of the conflict, even as it does drag on.
Talk to me about what's on your radar and maybe your scorecard ultimately for earnings this week. We got through a lot of the big tech names last week, maybe better than feared. CapEx spending very strong, hyperscaler spending a big storyline. How about for some of these, especially the semis names we're going to hear from the next few days?
We did. I think they're going to continue to dictate the pace at which the market is moving. We're keeping our eye on that. We're keeping our eye also on the private markets where we sit. Anthropic, OpenAI, raising record round sizes, and I think that's going to continue to really set the pace for the public, semiconductor, and AI companies.
Talk to me about a few more of those private names. We all see the headlines. Help the average would-be investor at home separate signal from noise for the SpaceXs, the Anthropics, the OpenAIs. I mean, these numbers that are getting thrown around, they're historically large.
Well, look, that's where all the action is right now. I think that's not, it's indisputable. A lot of the action is happening in the private markets, and a lot of retail investors are sitting on the sidelines and waiting for them to hit the public markets. I would say, there's a lot of numbers being thrown out. There's no set numbers. There's talks of valuations in the trillions. What I would say is I remain cautious about valuations, at such high levels when they hit the public markets. I would want to see maybe some of these companies develop a little bit more in the private side rather, develop more of that revenue and really have a good solid case if they want to try and command $3 trillion valuations in the public markets.
Yeah, well, we don't exactly know what the path forward looks like with regards to easing of interest rates, how restrictive or otherwise Kevin Warsh may be. But what's on your radar? What do you pay attention to for merger and acquisition activity? I know they all want to see interest rates come down. That is no certain thing. But what do you follow for M&A activity for the year?
They do. I think Kevin Warsh was a good pick. I think he's not as dovish as maybe people thought he would be. We did think that there were going to be more cuts coming. I think with the oil situation, it's maybe not so much on the cards anymore. I think overall the next 12, 24 months, we are going to see rates come down and we are going to see more deal making. Overall, I think the business climate right now, a lot of the actions that the Trump administration is taking have been extremely positive for business climate, and I think it's going to translate into more M&A and more deal making.
We have a lot of earnings. We have a lot of Fed speakers who are going to be making public comments over the next few days. We also get the April jobs report this Friday morning. What are you paying attention to give us some sense on the health of the underlying labor market?
I think we're paying attention to a lot of the disruption that's going on with AI. It seems like every week there's news that there's another layoff. There's another tech company that's laying off a big chunk of staff due to, AI efficiencies, and I think we're going to keep our eye on that. We want to avoid, I think, and most analysts want to avoid a situation where there's higher unemployment, it's increasing, and then the oil crisis and inflation is leading to a situation where the Fed's stuck and the economy doesn't really know where to turn. I don't think we're there yet, but I think it's something to look at, and we'll be looking at those numbers carefully.
All right, Juan Moreno, before I let you go, any other big catalysts on your radar you're paying attention to, you think we all would benefit from also paying a bit more attention to in the days and weeks ahead?
We're looking at secondary and tertiary industries that are being disrupted by AI. Legacy industries, financial services, healthcare, legal, insurance. We're looking at a lot of those. We're looking at the savings, the transformation that AI is taking into those industries, both on the private and the public side. And we see a lot of transformation going on there.
Juan Moreno, managing partner at Nassau Street Partners, an 11th hour film. My man, you crushed it. Please come back anytime.
I will, anytime.
The slot is yours. We'll talk to you soon. Skylar, grab your mic. Jeff will head this way. We'll bring you the top analyst calls that move the tape here on Wall Street on this Monday. First up, HSBC downgrading Palantir ahead of earnings to a hold from a buy on concerns about rising competition from other competitors like OpenAI. Shares of Palantir down about 20% on the year. They are set to report results any minute now on this Monday afternoon. Next up, Mizuho initiating coverage on Fannie Mae and Freddie Mac, both with an outperform rating. They say those mortgage giants have plenty of upside, a $10 and a $9 price target respectively. And finally, can we make it around this way of this live show? I think we can. Pardon me, bud. Finally, UBS reiterating McDonald's as a buy, saying investors should buy the weakness in the arches. Shares down 6% for MCD. They report this Thursday, just a few days from now, after the closing bell. It's a chaotic day down here. I love it. All right, we'll take a look at one ETF. It's usually a stock, but we got to talk JETS, Jets. This is the U.S. Global Jets ETF. Down 1.3% on the day after the shutdown of Spirit Air over the weekend. Delta, American, United, Southwest. They were all down, and they happen to be the four largest holdings in this ETF. JETS down 9% from the start of 2026. Last week on the J.D. Durkin Show here at the New York Stock Exchange, I caught up with CBS News contributor Javier David to talk all about hyperscaler spending and much more. Take a look. Javier, I wonder how you would diagnose how the consumer is right now. Is the consumer still holding the market up? Is the consumer starting to crack? What are you seeing from the data and reporting that you've been doing?
I mean, yeah. I mean, the answer to that one is also yes. Remember that old Sesame Street adage, the episodes with the voiceover guy? You might be a little bit too young to remember this, but it's like, today's episode is sponsored by the letter, whatever it is. And today, in similar fashion, this economy is really sponsored by the letter K. It's K-shaped. It's, the growth up at the top, but it's down at the bottom. People are really, really struggling. So there was a really good Yahoo Finance article that I clicked on earlier today. The headline said, TransUnion data showed subprime consumers saw their credit scores tick up, but the super prime consumers, the ones that have really good credit scores, saw their scores jump even more significantly. And meanwhile, you have this cohort in the middle. I saw the scores take a hit. So, the credit card data, the revolving data tell you everything you need to know. We have $1 trillion worth of revolving credit. People are taking on more debt, and I've been banging on this drum really since like 2022 at least. Revolving credit has become this sort of inflationary release valve for the middle and working class. People are just charging things in the hopes that they can just kind of keep up, and they have been keeping up. But it kind of shows you, look, it's with the surging cost of everything, it's held up, but it's not remotely sustainable, especially when you've got interest rates driving up APRs and by extension all the balances that people carry. So, that old saying as it goes, something will continue until it just can't.
All right, you brought a chart. We're very pro charts here on the JD Show, man, and thank you for this one. This is hyperscaler debt issuance. Now it's a party. We'll pull it up here from the control room. There it is. This is the first part of it. How much of this is being driven, Javier, by the AI arms race? And give us a bit more context for what we're looking at.
Yeah, look, the sheer mind-boggling amount of money that's being spent on hyperscaling AR, it's just staggering. After yesterday's earnings results, like the numbers actually got revised up. So we're talking about over $700 billion this year alone. So Barclays put a note recently that they said that total corporate bond investment grade corporate bond issuance this year going to be over $2 trillion, which is going to exceed even post-COVID record levels. So it just kind of like, you think about these numbers and you're like, okay, we're talking a lot about OpenAI, we're talking a lot about Microsoft and all of these big dogs, but the whole thing is, is the reality going to match up to these expectations? My sort of hot take, and I joked about this on LinkedIn a couple of months ago, is that there's so much debt being issued, and it's being issued by some of the biggest names in the business. It's almost like the AI debt is becoming safe haven trade, because meanwhile, all of this is taking place, and something that we also don't talk about a lot is the fact that treasury bonds and government bonds are kind of getting under a lot of pressure. Yields are rising. All of a sudden, you have a government that continues to spend and doesn't really have any plan to sort of corral that amount, the amounts that they're spending. Government debt all of a sudden just doesn't look as attractive, and it's not as safe as it used to be. So here you have all of these investment grade bonds, which are presumably rated AAA or AA or what have you. But they're highly rated and they're considered safe, so everyone's flocking to those. So can the market absorb all of this? One, two, does that kind of make AI bonds the next safe haven trade? And that comes with a whole lot of risk, because there's a whole lot of assumptions being made about the growth of AI and how these companies are going to make all of this money. And it's not entirely clear at all just how much they're going to be able to recoup all of this. But it's debt, and debt is usually, again, something that you have to pay back. And do you have the means to pay that back? Still.
Welcome back to the show. Joining me now down here on the trading floor of the New York Stock Exchange, the man himself, a very dear friend of mine personally, and an incredibly important voice here at the big board, Belisle Little, Director of ETFs at the New York Stock Exchange. My man, it is great to have you here.
Thank you. Happy to be here.
Let's talk all about the Creator Summit today. What is it all about that you and your team hosted here at the New York Stock Exchange, and what was one thing you learned today?
Yeah, no, good question. So the Creator Summit was designed to basically bring in retail investors. What we wanted to do is we wanted to collaborate with the retail investor, but more importantly, make sure that they had a voice in the room. Oftentimes, historically, like the institutions would create investment products, but they wouldn't include the end investor. We wanted to bring the end investor in, hear what they wanted to hear and say, and then communicate in a message that was important to them. The one thing that I did learn is that they are committed to investments, but wanting to learn. That was actually pretty eye-opening, because we often think that they don't have the sophistication level needed to participate in markets. In many cases they do. They have their own audiences, and they're trading and teaching the next generation on where the new opportunities are.
And man, what a time to hold an event like this, because ETF inflows has been such an incredible story for the broader markets, and from the start of 2026 alone, topping $500 billion in Q1. What are you seeing in terms of big picture launches, flows in the space these days?
So, good question. So the one thing I want to point out is that I think we moved past like this broad basket of assets that are coming to market in the ETF wrapper, and we moved into utility. Because of the volatility over the first part of the year, you saw a couple of different things. You saw traders and investors identify precision in the portfolio. Where do I want to express my oil trade? Where do I want to express maybe a growth trade? Where should I hedge the portfolio? So that's one. The second thing is we see different types of products come to market right now. We're seeing a lot of structured products come to market. We're seeing a lot of auto-callable strategies come to market in the ETF wrapper. And typically, we've moved past this just, hey, long-only strategy. We're adding options, derivatives, and swaps, which creates new opportunities in the space.
Do you see most of the action being driven by the institutional side, most being driven by the retail side, or is there still a pretty healthy balance between both?
I think it's always a healthy balance between both. Here's what happens. The institutions say, hey, this is what we want to launch. The market will dictate if they're going to accept it. So we do see there's, I would say, a gold rush to yield-based products. I think you also see a major opportunity within fixed income. That's still a major opportunity when it comes to active ETFs, because 9 out of $10 are going to be invested in the active ETF wrapper.
Yeah, we got an interview coming up just a bit here on the show with JP Morgan about that exact issue. Talk to me about what you see as being the next wave of ETFs. You're one of the very smartest people I know because you have your finger on the pulse of what's happening now, but I got to imagine you got a strong sense about where all of this goes from here, and there's a lot going on.
Yeah, there are. I think you're going to continue to see the need to express risk-based managed strategies. So how do they hedge out duration risk? Where can we hedge out credit risk? Where can we actually think about where the volatility is coming? That's the biggest issue right now. You need to figure out how different ETFs fit into a portfolio. So the issuers that we see come to market right now, there's still a lot of managers that are listing and launching with large value strategies, which value's been out of favor for a long time, but there's still pockets on the industrial side that might make more sense. So you still see really attractive sectors. I would also see you have blended strategies that are coming to market. You start thinking Bitcoin gold, you start thinking these different types of flexible solutions, because now you can express more views and have condensed wrapper, which allows people precision in the portfolio.
Correct me if I'm wrong, this was the first time you've done something exactly like this, the Creator Summit today at the New York Stock Exchange, right?
Never existed before.
Never existed before. I'm almost out of time. What do you hope this becomes here for the community? Because you did this today and it was a packed room.
Yeah, I hope it's a staple. What we wanted to do is we wanted to provide access. Information cannot flow one way, it has to flow two ways. And if it's mutually beneficial, then we would actually have a more engaged listener, investor, and more risk-based investment solutions made for clients.
The Creator Summit, the first of its kind here at the New York Stock Exchange, undoubtedly the first of many. The great Belial Little, Director of ETFs here at the New York Stock Exchange. Congratulations, man, you did this today. Way to go. Mamba out. Don't go anywhere, a lot more Taking Stock coming up right after this. Let's rock and roll. Travis Spence joins me now down here on the trading floor of the big board. He is the global head of ETFs at JP Morgan Asset Management. Not just a great guest, but a great guest who just rang the closing bell. Thanks for joining us.
Pleasure to be here, JD.
So bond ETFs alone, they've pulled in more than $163 billion this year. What do you think is really driving that rush into bonds, the fixed income side of things?
Yeah, well, look, I think fixed income is here to stay. You've got yields that are still high. You've got a really positive environment for corporate fundamentals. We think that's an environment that bonds do well in. But I think in terms of the ETF volume, I think what's driving a lot of the ETF volume, 40% now this year, is active fixed income ETFs. And when you think about the overall market, take mutual funds as an example, most of that is actively managed. The ETF industry has been, almost imbalanced because we see most of the exposure in passive. Now we're seeing that shift, and the active fixed income ETFs are really starting to drive the flows.
So as you and I are talking, we call these the cubes, affectionately, down here on the floor. We see a bunch of these offers, and let's go through a few of them. For instance, JCPB, kind of your base level bond exposure. JPIE, more flexible, lower vol. If you're interested in some global offerings, JBND. How should investors think about allocating across the spectrum with some names like these?
Yeah, look, we've launched now 16 active fixed income ETFs. So really think about it as across the entire range of fixed income exposures. And some of those are from core into the extended sectors. We also have ultra short that we launched back in 2017. Now the largest active fixed income ETF in the world, which is JPST. So you really can cover the entire range. And I think what's really interesting is that now you're starting to see a lot of investors take notice. And they're starting to take advantage of having the ETF wrapper with active management. I think what makes us a little bit unique, JD, is that we've been running fixed income strategies for decades. In fact, today we're celebrating here also crossing over 1 trillion in fixed income, our broad fixed income platform. And we've got now 100 billion that sits in active fixed income ETFs. So that's been driving like a lot of the volume that we're seeing. But what makes us unique is that we've been running these strategies for decades. We've taken the best of our active strategies and put them into the ETF wrapper. And I think for fixed income, when you think about transparency, the accessibility, the way that spreads trade, and the level of liquidity that you have in active fixed income ETFs, they're a preference for many investors. And so again, we're really excited that we have this broad platform that investors can access across their fixed income portfolios.
And overall, are you seeing more interest on the active side than the passive side for fixed income ETFs? And if so, what does that tell you about not just where people are, but where they still want to go?
Yeah, no, 100%. I mean, I think where the markets are now, like a lot of investors are over-indexed, and you don't want to be there in fixed income especially. You want to be active both for duration as well as credit. And we've got strategies that have been outperforming, passive and the broad indices for a long, long time. And that's where it becomes exciting to access these in the ETF wrapper now.
What would you say is the strategy from here moving forward for active fixed income ETFs, part of the general JPM ecosystem?
Well, I think you're seeing investors, go back to that. You're seeing investors now have an ability to go into strategies that have been proven for the last few years in active fixed income ETFs. So I think that's going to increase momentum. It's going to increase focus on that. And if you just think forward a few years to most of the ETF exposures being represented in active, like in the mutual fund industry, you can see an industry that now has doubled over the last couple of years to about 550 billion in the US, probably grow to over 2 trillion over the next 5 years. So that's an exciting thing for investors, an exciting area for us to be playing in as well.
Travis, congratulations. It's an exciting suite of products for the right investors out there, and obviously it's been very popular and successful.
Great.
Thanks a lot for joining us. It's
Thanks,
nice to have
JD.
you on the
Thank
show
you.
today. Don't go anywhere. A lot
Thank
more
you.
Taking Stock coming up live right after this. Hey. Welcome back to the show. Time now for a few fintech, crypto, and artificial intelligence related headlines for your Monday afternoon here on Wall Street. First up, Bitcoin up almost 2%, touching 80,000 for the first time since Saturday, January 31st. ETH and Solana in positive territory on the day as well. Next up, Coinbase saying a deal has been reached on the stablecoin yield fight. This is a big one. It's been holding up crypto legislation in the U.S. Senate, potentially clearing a path for the Clarity Act at long last. And finally, Blackstone set to launch a $1.7 billion IPO for a brand new vehicle that's set to buy up newly built data centers to ride the artificial intelligence boom, listing right here at the New York Stock Exchange under the ticker BXDC. And now Money 2020's very own Scarlett Sieber is back with a new edition of Jargon Translator. That's where she puts wonky, complicated fintech terminology into language that anyone can understand. Take a look.
I'm Scarlett Sieber from Money 2020, and this is Jargon Translator, where we take the words everyone throws around in meetings and explain what they actually mean in real life. Today's term, technical debt, aka we'll fix it later with interest. Technical debt happens when you take shortcuts in building technology to move faster today when it will cost more to fix down the line. Think of it like skipping oil changes on your car. It runs fine until it really doesn't. I've done that 1 or 2 times, just saying. In fintech, technical debt shows up everywhere. Hard-coded rules that no one remembers writing. Systems layered on top of systems. Quick fixes that quietly become core infrastructure. At first, tech debt feels productive. You ship faster, you hit deadlines, everyone's happy. But just like financial debt, the interest compounds. Every new feature takes longer. Every regulation becomes harder to implement. Every outage takes more effort to untangle. So here's the important nuance. Technical debt is not always bad. Most successful companies intentionally take it on early. Speed matters, perfection doesn't. The problem starts when teams stop tracking it or pretending that it's not there, because eventually that debt, it starts dictating all of your strategy. You don't build what you want to build, you build what your system will tolerate. Technical debt isn't just an engineering problem, it's a business risk. It affects cost, scalability, compliance, and customer trust. Technical debt is the price you pay for moving fast, but ignoring it is how fast turns into fragile. So with that, that is your jargon translated. If there's a finance term you keep hearing and you want the real story on, put it in the comments and it just might make the cut. In the meantime, back over to you.
And tomorrow here on Wall Street, which will be Tuesday, May 5th, we got the latest quarterly results from a handful of crucial names. That includes results from Shopify, PayPal, and Pfizer in the morning. This time tomorrow after the close, the latest quarterly figures from AMD and AMC. Also got a few important pieces of economic data set to cross the wires for investors to digest tomorrow. The March job opening and labor turnover data survey, also known as JOLTS, new home sales, plus the latest figures on ISM services data. Your final tail of the tape on this. May the 4th be with you. The S&P down 0.4, the Dow down, the New York Stock Exchange Composite Index and the small caps both down 0.6%. I'm being told to wrap. Thanks for watching the show. Have a good one. We'll see you again tomorrow.